Hello everyone, this is Samantha Gale from the Alberta Mortgage Brokers Association. Today I'm happy to introduce Teri Tetreault, who has been working in the tax industry since 2001 and is currently the president of Pi Business Solutions. Before passing the mic to Teri, if you have any questions during the presentation, please type them in the chat box and they will be addressed by Teri after the presentation. Now I'm going to pass the mic over to Teri.
Thanks, Samantha. We were just doing a musical chairs there. I have one small piece of housekeeping. I guess they're testing the alarms here at AMBA, so if you hear the fire alarm go off, don't panic. If you hear the fire alarm going off and us screaming, then that's the end of the presentation. So I just wanted to dive in on some of the new legislation. I know there's been a lot of talk with the government changes about what's new with the tax system this year. We're going to focus mostly on personal taxes. And then we'll do a little bit of discussion about small business taxes and a little bit about corporate stuff while I'm here. So I'm going to just zip ahead to the first slide. Basically, what we want to cover is what's new in 2015 and 16. So obviously, especially in Alberta, so we've had two elections, right? So now we have provincial NDP government and federal Liberal government. They obviously have different views from the Conservatives, so that usually leads to changes. The biggest one that's happening as far as the federal government goes is a new tax bracket at $200,000. So basically anybody who makes more than $200,000, this is per individual, not family, we're going to see a new tax bracket there and a 33% tax rate. Before now, there was a tax bracket that just went from 135-ish thousand up to infinity, and it was at 29%. So now from 135 to 200 will be 29, and then beyond 200 will be that 33% rate. So as far as the federal government goes, you're going to see an increase at 200,000 in income. The rest of us, actually, hopefully none of us at one point in time anyway, won't be affected. But once you're over 200, you will. And in 2016, then we're going to see another small change, or at least it's a proposed change anyways. We're going to see the budget from the Liberals in March. That's usually when they come out. And then we'll have a lot more details on the changes that are going to result from the Liberal government. But basically right now what I'm talking about is conjecture. The new tax bracket is in effect this year for 2015. And then for 2016, Trudeau is saying that they're going to reduce that second tax bracket rate from currently 22% to 20.5% federal tax. The politics behind that are really quite interesting because it's supposed to be some sort of tax cut for the middle class, and it's going to have that. It's not going to have that effect at all. The people that it's going to help the most are people who make between $90,000 and $212,000 in personal income. One person. So as a family, that's between like $180 and $420. Which is not at all what I would call the middle class, but that shows what politicians know about tax, I suppose. Anyways, so it'll help anybody who makes more than $45,000, and it'll help you the most if you make more than $90,000 but less than $212,000. And we'll see that reduction in 2016. So that's kind of what's going on with federal brackets that we know about. And then obviously in March, they'll release the new budget, and we'll find out more. As far as the provincial taxes go, I think most people have the most concern in Alberta because the NDP are so politically different from the Conservatives. I think people are quite panicky about what the income tax changes would be. And it's not that bad. In 2015, we're barely going to notice. So they're introducing a whole bunch of new tax brackets starting in 2015, and then they're going to change the tax rates on those brackets a lot more in 2016. So right now in Alberta, until the end of this year, or no, pardon me, until the end of last year, nope, until the end of 14, sorry, the income tax rate was a flat 10%. So with the introduction of these new brackets, you're going to see increases by the end of 2016 all the way up to 15%. So if you think 10, 15, what's the difference? Well, think of it this way. It's actually a 50% increase in your tax if you're making more than 300 grand. So when you used to pay, let's say your income was $330,000 and you're $30,000 over the $300,000 threshold, on that 30 grand you used to pay 3 grand, 10%, and now you'll pay 15 grand, which is 15%, or not 15. My math is terrible. So 3 grand to 4,500, right? So it's still a 50% increase in how much you pay. It's significant and it's going to hurt, but the idea behind the change is that it's only going to hurt people who make significantly more than 125,000. So we're going to see new tax brackets from the provincial government starting in 15. Those brackets will be at 125,000, 150,000, 200,000, and 300,000. Or no, pardon me. 125, 150, and 300. So we'll see increased taxes in 2015, but just a bit. In 2015, we're going to see a 0.5% to a maximum of 1.25% increase. In 2016 is when the big tax brackets kick in, and the highest tax rate will shoot up to 15% from the current 10. So if you are one of those people, or if you know people who are making more than 300 grand, their tax rate used to be 39%. It's going to shoot up to 48%. That makes a big difference. I mean, it's 9%. If I said to you, give me 9% of your paycheck every month, you'd be able to save money like a crazy person. If you were, setting it aside instead of giving it to me. So instead, you're going to be giving it to the government. So nobody's going to like that. But it does make a big difference in the taxes. So those are the important changes to the tax brackets. And again, mostly affecting only people who make over 125,000 so far. And then if you make less, actually, I suppose the reduction in the federal tax next year will be helpful. The other thing that's coming, anyways, it's still somewhat up in the air, but the Liberals, the federal Liberals, promised to change the way they administer the universal child care benefit, child tax benefits, and child credits. The one thing that's changing right now is the removal of the child amount. Currently, anybody who has a child under 18 gets this credit. The credit itself is approximately $2,300, and they're just taking it away. And that credit's worth to you about $335, and it's just gone. And that's already happening in 2015. And then in 2016, there's this thing called the universal child care benefit too. So this guy's it's not based on income. Basically, if you have a child, you get currently $160 a month if your child's under 6, and $60 a month if your child's over 6. They just changed that in July. You probably remember because you probably got a check from CRA for a completely random amount of money based on the number of kids you have, just in time for the election. Perhaps coincidence, perhaps not. So the Liberals have promised to completely do away with that entire system of universal childcare. And to be perfectly honest, actually, I agree with it. That system is ham-fisted anyway. And then but they're not taking it away. We're going to lose that one credit, but they're not taking away the universal child care. What they're going to do is they're going to roll it in to the existing child tax benefit system. So currently, low-income, the lower income, the more you get, Canadians get child tax benefits. So the child tax benefit comes to you totally untaxed and sort of behind the scenes. And what the Liberals are going to do is they're going to take the money that they were paying out through the universal child care benefit and roll it into the child tax benefit. So you're still going to get that money. In fact, you'll probably end up getting more under what they're proposing, but we'll see in March, right, when they actually make a budget. You'll probably end up with more than you did before because they're just going to redeploy that money. So we're not really losing anything there. They're just redeploying the budgetary effect of those things into one system and putting it all to the child tax benefit. The people who are going to lose by that are the ones who make the most money because the child tax benefit system is based on income. So if you have high income, you're going to lose all child benefits, all of them. So right now, even Mark Giordano is getting his universal child care benefit, but he won't anymore because his income will be too high. When that's gone, it'll be based on income instead, like the child tax benefit. So that's the big change there that the Liberals are proposing. For now, it's status quo. And because of the way they run the years for child tax and social benefits, they usually run from July to July or July to June. So I assume that you'll see those things finally cut off next June of 2017. I assume, but again, we'll have to see what the Liberal budget actually says. And then it'll roll into one integrated system of child tax benefits. And like I said, when that happens, all of these child tax benefits will be tax-free, for one thing, which greatly simplifies the situation. And two, depending on your income, you'll probably get more money. So that's the Liberal philosophy on that. And that's the change we expect to see next year. There's been a couple of interesting changes with the Canada Revenue Agency. To be perfectly honest, I could probably do a week's worth of horror stories about dealing with the Revenue Agency in general, because well, because I'll leave it to your imagination, but it's bad. But they've made a couple of really important changes that they're implementing finally this year. One is they say, anyways, they've been saying it for 2 years, that they're going to stop issuing checks, period, for anything this summer. Like literally, old age security, income tax refunds, GST credit, anything. They're literally saying that they're going to stop issuing checks. Personally, I think that's going to be an unmitigated disaster, but it's still a great idea because it's a complete waste of postage, a complete waste of paper and ink when they can do direct deposit. So one little tidbit that I'd like you to take from this is when you file your taxes this year, get yourself on the list for direct deposit. If you haven't done it, do it, because what's going to happen is, if you remember when, do you remember when U.S. Border Patrol changed the rules so that we had to have passports to enter the States? And then the passport offices were a complete train wreck of people trying to get passports. It's going to be like that. So avoid it. Go on direct deposit. You'll get all your refunds, all social benefit checks, all that stuff directly deposited. Depending on the demographic of who I'm talking to, that may already be easily the case. But tell your grandma, tell everybody, because they are going to stop issuing checks, and it's going to be a mess unless that's already going into your bank account. So that's just one little change that to make, I mean, I can't believe I'm saying it, but the government might actually become slightly more efficient. It scares me to even think of it. So, but you don't want to be the one waiting for that check and you can't get it because they're not writing checks anymore. And then another interesting thing about what CRA is doing is they're finally posting all slips and tax documents on the internet. Through what you would see as my account and what I see as represent a client. So before you could just get your T4s, T4As, and a few other slips. Now you're going to be able to see all of your own tax data. And I shouldn't say this as a tax preparer, but it's going to be downloadable. So there's going to be virtually no reason you won't have your own tax data to prepare your own income tax return, which is going to be really, really bad news for the H&R Blocks of the world, but it won't affect people who actually employ strategy in their tax planning and preparation. So you will have access to your RRSP slips, T3s, T5s, all government issued slips. Those will all be there online, which currently you can't see. So that gives you more resources. It gives us more ability to not screw up taxes, and it provides you more and simple access to your own data once you set up a My account through CRA. It's a pain in the butt to do because they have to mail you, like snail mail you, a password. But once you're set up, you have online access to your own tax files all the time. You can submit documents when CRA asks for them. You can file formal objections. You can do all kinds of cool stuff with that. You can, if you're somebody who owes tax all the time, you can set up your installments. You can do everything through there. So it's actually I detest the CRA, but I love their website. It's really, really handy. So that's they're going to be offering more online services and better online services than they had before. So that's something worth noting too. But the most important change from the CRA and from the government in general is, and so like social, what do they call it? Service Canada, or as I like to call them, Disservice Canada, is the removal of checks by this summer. So get on direct deposit, tell your grandma, tell everybody you know, because it's going to be a mess in July if you're not ready. So that's some of the new stuff that's happening. I'm really, really curious, obviously, to see the Liberal budget in March, just to see what really comes of it as far as it affects taxes, because they talked a big game, so it'll be interesting to see. So if you have any questions for those, chuck them in the chat, and then we'll answer them at the end. I'm just going to forge ahead now to a little bit of stuff about business. So the big question, and I don't have time, I mean, this is an hour topic by itself, about if you're self-employed, and I know many mortgage brokers are, if not nearly all of them, whether you should be operating your business as a sole proprietor or a corporation. And the short answer to that question, and I'm going to keep it very, very short, is ignore the conventional wisdom and understand that the best reason to incorporate, if you're in a situation, first of all, you have to be a business. There's very specific rules about people who look like employees, but they call themselves a corporation. That's another 2-hour conversation. But if you're a business, the important thing to decide whether you should incorporate is very, very simple. Are you making more money than you need? If you are, and you can afford to leave that money inside a corporation instead of taking it out for personal use, then there's an excellent chance that you should incorporate because you will save a significant amount of tax. And I purposely stressed in the first part the increases to federal personal income taxes and provincial personal income taxes. As it stands on the previous federal conservative budget, corporate taxes are actually slated to come down. So the tax savings by incorporating are going to be even better. If you have to pay personal tax on your income at ever increasing rates, you're going to pay dramatically more tax than I'm going to pay on my corporate income. So incorporating is becoming even more attractive as long as it suits you for other reasons. So I want to be clear about that though. If you're barely making enough to pay the bills, and everybody's bills are different, so that's not a judgment, then incorporating is probably not for you. You're just going to make your accountant rich, and we like that, but it's not the best advice. So what I suggest with the corporate is the most important thing, and if you saw my presentation in Drumheller or Lethbridge, I always say the exact same thing. If you can afford to leave money behind in your corporation, you will enjoy a much lower tax rate on that income now and probably over your entire life than you will if you're not incorporated. It is hugely powerful. I can't understate how much tax you can save by that if you're disciplined and if you're making more than you need. That's the important thing. I mean, if you're making 60 grand and you have 2 kids and you're a single dad, good luck. You're going to need all that money for sure. But if you can afford to leave money behind in a company, you can afford to save. You can afford to do 2 things at once that's very difficult to do. First of all, you save money, and second of all, you save a ton of tax doing it. Another thing like that is RRSPs, right? Save money, save tax at the same time. I've seen people completely restructure their family finances around a corporation successfully. In fact, I did it myself. And you can save a phenomenal amount of tax over a lifetime by doing that. So that's all I want to stress about the incorporation. I mean, clearly that's a long topic, and everybody's situation is different. Just leading up to a deadline here on February 29th, I went through something like 20 corporations to get them all done as fast as I could. Every one of them is different. Everybody has its own little nuances. Everybody has different ways of saving money, and you really need to talk to somebody who knows what they're doing to take advantage of that properly. That doesn't have to be me. Find somebody who knows what they're doing, get the right advice, and then you'll see the whether and how to incorporate, and then how to use that to save tax. It's a phenomenal amount of money you can be talking about over a lifetime. I literally mean hundreds of thousands of dollars. So I'll leave that just as more of a teaser than anything else. And it's sort of one of those marketing tricks or something. Call me, or call someone anyways, and get that good advice. So that's just the old business structure convo. And then I like everybody can write off the same sorts of things as a business. And I know most of you are self-employed, so I've just covered some of the really common stuff here, and I'll try to be brief with it. But the big ones, there's 4 categories of expenses I always talk about. There's vehicle expenses. So if you're a sole proprietor, not a corp, you want to keep track of your gas, repairs, insurance, registration, lease, depreciation, all those sorts of things. You need to keep a kilometer log to track what percentage of those things are allowed, right? You can't just make up a number. Well, actually you can, and to be perfectly honest, most people do, but CRA will demand to see a log. So keep a log at least for 3 months at a stretch, because you can say, hey, this is what I drove in 3 months. I just multiplied that by 4 and it's close enough. If you're a corporation, we actually don't need to keep track of those expenses explicitly. What we can do instead is use a kilometer allowance. You just tell me, I drove 8,000 business kilometers this year. I do some math and it's done. So, and you don't write off the actual expenses. Like for me, I just, when I'm at the gas pump, I don't get my receipt. It just says, do you want a receipt? I'm like, no, waste of paper. I just need to know how many kilometers I drove for business. So we claim the vehicle expenses either way, but if you're a corporation, we keep track by kilometers. If you're a sole proprietor, we keep track of the actual expenses, which are listed there on the presentation. The next big category is your home expenses. For all intents and purposes, if you're self-employed, you can claim the operating costs of your home. Generally, if you like renovate the bathroom or something like that, no, you can't claim that. but the operating costs like your mortgage interest, your property taxes, insurance, utilities, those types of month-to-month expenses, you can claim those. Can you claim them all? No. CRA says you have to claim what's reasonable, and they don't seem to have any problem with 15% because I've been claiming that for 15 years, and I've put it on, I don't know, thousands and thousands of tax returns, and I've seen it audited, and the auditor just goes, oh, 15%? Fair enough. So those two categories, you want to keep track of those. If you have the home expenses, we track the same way, whether you're a corp or a sole prop. The next category, I don't think I broke down separately. My chat box is in the way. Oh, I did. So where it says other tax deductible expenses there, I usually give cell phone a category of its own. Generally, we write it all off. You probably shouldn't. It's a matter of whether it's personal or business, so keep track. If it's mostly business, just write it off. And then the other tax deductible expenses, this is stuff that's business only. The business only stuff is really, really simple. If it's an absolute mandatory cost of running your business, like a business license or a liability insurance, I mean, those are dead obvious. Of course, you can write them off. If it's something that you think is going to help you make money, you can write it off. So that's where buying me a coffee because I'm going to save you money is something that CRA would be happy with. Or if you take a client out for dinner, something like that. In your world, it's a very social world like that. Those types of expenses are absolutely claimable and reasonable. So anything you think might make you money is going to be allowed. Anything that's a mandatory necessity of the business is going to be allowed. CRA wants you to tie your expenses to either income, the attempt to earn income, or the attempt to save money. Those are the things CRA wants to see, because the more profitable you are, the more they can tax you. So their logic is pretty simple. And I see a lot of crazy stuff. People say, oh, my wife and I went to Mexico for our annual general meeting. Yeah, not deductible. Don't even try. A bunch of accountants are pulling that too, because I've seen it over and over and over again. I don't know. I wouldn't want to be at that audit because you're just going to get embarrassed. So try to be somewhat honest with yourself. And then meals and entertainment is always a contentious issue. I should say you can't write off clothing pretty much ever. Safety equipment you can, like flame retardant, stuff that glows, things like that, sure, but you can't write off business attire whatsoever. And meals and entertainment, don't bother claiming your receipts if you just get coffee every morning. Don't bother. Make sure it's business. First of all, it hardly makes any difference anyway. And second of all, why look like a complete fool if CRA audits you and says, oh, you've been claiming your Subway every day for lunch? What else are you hiding? And your Subway saved you $48 that year or something like that. So you want to think of the big picture and look conservative, be conservative, because it doesn't make that much of a difference for some of those expenses anyway. So, and then that'll lead to a flurry of questions a lot of times, but more or less just guide yourself by two principles. Is it helping you make money? Is it mandatory? Those things will be claimable. And then the house and car, because they have dual usage, right? Nobody's car is 100% business, although I've seen people try to say that's the case. And nobody's house is obviously much more than 100%, much more than 10 or 15% business. But good exceptions might be a day home, right? Or a bed and breakfast. Maybe it's 40 or 50% business. So those are all conversations that you should either have in your head, which sounds like something I would do, or have with an accountant who can guide you along what CRA's guidelines are to keep you out of trouble. So those are some of the obvious write-offs, and I think the last slide is just the question slide. So I have no idea how long that took, so hopefully not 3 hours. I think it's just the question slide. So if you have them, I guess shoot them into the chat box, and then I'll read them back out and answer them verbally. I'm told this is my first webinar, so. Or it was so brilliantly presented that there are no questions. Come on, I know you have one. Or everybody's sleeping. Crickets. All right, I'll let Sam close the presentation, and luckily the fire alarm didn't go off, so she's still here.
Thanks, Teri. Thank you, Teri, for presenting today, and thank you to all of our participating members in today's webinar. And we will see you at the next webinar. Our next webinar is March 31st. We will be sending you details on the upcoming webinar. We have not yet released it, but we will be soon. Thank you.